Well, our market master of the day is Ridham Desai, and he's joining us right now from the sidelines of the Morgan Stanley India conference. His recent report, published on the 29th of May, titled "How India Has Transformed in Less Than a Decade," has been the topic of discussion and much enthusiasm since it was published. I mean, I can say that I've spoken with Ridham on markets on the air for at least 15 years, and I can say that apart from tracking micros, Ridham also zooms out and looks at the bigger picture for India. For example, earlier, just this year, he published a report titled "Why This Is India's Decade." Ridham, it is a great pleasure speaking with you. Thank you very much for your time. Appreciate it here on CNBC-TV18. Let me start by asking you a simple question, Ridham. Out of all the transformational changes which you list out in your latest report, which is the one, to your mind, which will remain the most relevant for investors over the next many years? Which one is the most durable, according to you?
Hey, thank you, Prashant, and thank you, all of you, for having me here on CNBC. Glad to be back. So, Prashant, that's a very difficult question to answer because there is never, at any time, there's never one thing that makes the difference. If you're going to push me to the wall, then maybe I would say that achieving macro stability via inflation targeting is the likely standout. But then you cannot undermine the creation of infrastructure, which is so critical to doing business. You cannot undermine the success that we've had in engineering social transfers and reducing leakages, because all these things have led to this transformation that the economy is currently experiencing. So very difficult to point out one of them, but maybe these three are standouts, and there are more, of course. And it is like if you do one thing, then you achieve one result. If you do many things, then you get a compounding effect, which is what I think India is experiencing today.
A lot of the macros have improved substantially, right? Whether it's the GST collections, the PMI data, GDP growth, even, things like auto sales, for example, come back after a long time. But do you think a lot of this is in the price as far as the Indian stock markets are concerned? Because we are virtually at all-time highs now.
Sonia, the market is not yet at all-time high, but remember the level that we are trying to cross is the one that we achieved in October 21. So effectively, we've done nothing for the past 18 or 19 months. And in the meanwhile, it's not like earnings have degrown. Earnings have only grown. I think we're ending F23 with about a 16 to 18% growth rate. So yes, in October 21, the market had probably gotten a little ahead of itself and needed to go through this really long consolidation period that we have seen. Also, it was accompanied by significant outperformance that India experienced because the rest of the world was very much in tatters through 2022. And when the rest of the world, and when I say that, I mean emerging markets, started making a bit of a comeback in October 22, India underperformed. Yeah. And then we have suffered this underperformance until March. So I think, the all-time high is not a relevant data point in assessing how much is priced in. Rather, we should, adjust the market for expected growth rates. And it's not like that the market doesn't know that India is likely to do quite well over the next 3, 4, 5 years. But all of it will never be in the price. And the common thing that the common refrain I hear from investors is that India trades at a high P multiple. But then earnings are very depressed. Remember, profit share to GDP collapsed to 2% by 2019, is now back to 4%, but is likely heading to 8% in the next 3, 4 years. So there's a lot of compounding of earnings that's still left to happen. And in that context, I don't think stocks are that expensive as they look on a headline basis. You have to adjust corporate profit margins and make them normal. And when you normalize earnings, stocks are actually still a buy.
Ridham, urban India is doing very, very well. And India definitely is on the path, and everyone's very bullish. The only problem is rural India is still in some pain. I wanted your comment on that because it appears that, that is yet to recover, which is important from an India perspective.
So, Nigel, I think rural has probably seen the trough and save for some really bad weather that we get in the ensuing months and a total failure of the monsoon, like a 15% drawdown on rainfall versus average. I think in 3 months from now, you should see pretty good signs of a rural recovery. So the seeds have been sown. Coming out of COVID, rural India actually took it on the chin. urban had led the recovery, and now it's spreading to rural India. It's inevitable that rural India starts flourishing. So I am actually quite constructive on rural India, and in fact, in our recommended portfolio of stocks, we have a lot of rural players in there because we think that they should do quite well over the next 12 to 24 months.
One of the things which is a change which seems to be a change is manufacturing in India, right? Global companies wanting to set up factories here in India, and we're hearing more and more of that. It's something which we've discussed for many years, never happened, but now looks like it's starting to happen. Do you reckon, from a manufacturing standpoint, India in 2023 is kind of similar to where, say, China was in 2001? China joined the WTO in 2001, and post that growth, really, manufacturing there really took off in a very large way. Or do you think it's kind of exaggerating? It's a very different place now. And but if you do agree, what are implications for investors in your opinion?
See, there are similarities and differences, Prashant. So I think the similarities with respect to domestic demand. So I think you have to go a little bit forward in time, say around 2007, 2008, when China's per capita income was just about where India is today. It's when an economy, it experiences a J curve. So it was around $2,200, $2,300, which is where India ended 2023 at. Ended 2022 at. And that's the time when there is a perceptible shift in domestic demand. Now that is what multinational companies want to gain access to. So, one very good anecdote to cite, which everybody will appreciate, is Apple opens its first store in China in 2008. Apple opened its first store in India in 2023. And there are a lot of similarities with it. China's per capita income, China's share of Apple revenues were around 1.8%. India's share of Apple revenues are estimated at 1.6%. So that's the similarity. But that's about it where it ends. Everything else is different. So one of the first differences is the change in the global geopolitical landscape, which is driving a multipolar world, where companies at the margin are seeking to diversify production out of China and take it elsewhere. Now, India seems to be a very attractive place to go to. For one, because it has a market which everybody wants to gain access to for the next 10, 15, 20, 30 years. And the second is that there are incentives that the government is giving to overcome the cost of doing business, via lower taxes and via, production-linked incentive schemes. So that's one difference. The second big difference is where we may be in terms of global growth. So global growth was at a very different level in the previous 30 years. Now, going out into the next 10, 15, 20 years, it's likely that global growth is not as fast. The world is aging. It has a lot more debt on its balance sheet and is likely to grow a whole lot more slowly than what China did, what China experienced when it was going outwards. So, that's another thing that kind of makes India a little bit different from the situation in India, a little different from China. So India will have to rely a lot on its domestic demand, on its domestic conditions, and add on the export growth that will come to it. Whereas China, did not need to do that, given how strong global growth was in that period when China was actually adding manufacturing capacity. And the last difference is that, at the time when China was adding manufacturing capacity, I dare say that there was a lot of capacity that the world needed. Today, in a lot of sectors, that is not the case. So it will be a little bit more selective. Having said all of this, we do see India's manufacturing grow as a share of GDP. That, by the way, has stagnated over the last 25, 30 years. In fact, in many parts declined. And we see a very robust improvement in manufacturing share of GDP over the next 10 years. So manufacturing is certainly a renaissance story in India.
Okay, and just in reference to that point you were making about consumer demand picking up, right? We've seen a K-shaped recovery, and the upper portion of the K, the premium end of the market, has come back in such a big way, whether it's real estate, autos, etc. I'll come to that in a bit, but Ridham, what also stands out for me in your report is you speaking about unprecedented growth likely in the financial services space, and you've put out a very helpful chart where you speak about how between 2012 and 2022, the loan growth that we saw compounded for the financial services space was just 10%. And now the anticipation is from 2022 to 32, it could be a 17% compounded growth. Now, my question to you is this. Will it largely come from the, the private sector banks, which are well-owned, well-identified, or do you see new spaces in financial services that one can, take the opportunity from?
So see, Sonia, with respect to financial services, let me cite the starting point. Private credit to GDP is in the high 50s, and that's fairly low compared to the rest of the world. So India is underpenetrated. India is under-levered, especially corporate India, which has experienced a pretty big decline in debt to equity or balance sheet leveraging over the past 5 years. So that sets the stage for what I would say, what I would call a loan boom. Then on top of that, I think India is entering into a pretty sustainable investment phase, because in a lot of sectors, we have not added capacity in the last 10 or 12 years, and capacity utilization is rising. So that again supplements the case for a loan boom. So we should experience pretty much higher credit growth than what we have seen in the last decade. Not at the level which we saw in the first decade of this millennium, but much stronger than what we've seen in the last decade. Because in the first decade of this millennium, the starting point was even lower. Corporate debt to GDP was just 25%. Today that number is about 50, down from around 62, 63. I think by the time we are done and dusted with this cycle, this number will go into the 80s. And when you just do a simple math, if that share of corporate debt to GDP is rising from say 50 to 85%, plus personal credit is rising, and GDP growth is say 10%, you arrive at this number of around 17% compounding. So that's one aspect of financial services. The other aspect is non-credit related financial services. That will also see, I think, much larger penetration in the coming decade. So across the board, I think financial services should do fairly well over the next 10 years. In fact, I would say even longer, but we are not going beyond the next 10-year period. So the next 10 years look like a very good period for financial services.
We have been quite happy in the last couple of months. The flows have returned back to India, but it's still a fraction of what they sold in the past. Do you expect more of the same? I mean, India continues to remain the preferred market, going by what all you just said as well. Earnings growth is something that stands out. So maybe these hefty valuations are justified. Your take?
So see, Nigel, one of the reasons, or maybe a couple of reasons why foreign investors have not been buying India. One is, of course, that they are still not comfortable of the valuations, the headline multiples. So we saw some correction in that between October and March, and so foreign flows have returned. The second is the outlook for emerging markets. Remember, it has been quite tepid, and we did change our view on emerging markets last October, and we continue to remain bullish going into the next 12 months. So that helps because India is part of the EM cohort, and when EM experiences flows, India gets its kind of fair share. I would say on the aggregate, foreign portfolios are slightly overweight India, but a whole lot lesser than what they used to be. India was, a very favored market many years ago. It has ceased to be in that category. I think it should attract more foreign flows. But remember, Nigel, in the stock market on a daily basis, flows are zero, right? Because if somebody is buying, somebody has to sell. The problem here is that we have a very strong domestic bid on stocks, and it's not going to go away anytime soon. So if foreign investors also want to buy stocks, and if domestic investors are buying at the same time, and if companies are not issuing capital, then you basically get a situation where share prices have to go up much more quickly. It's not a very healthy situation to be in, but ultimately, of course, those who are long will be very happy with that. They will get very quick gains. What I suspect is likely to happen is that as the foreign bid comes back on a more sustained and larger basis, I think you will see the IPO markets start to open up, and the supply will come, which will then keep price reaction more moderated. Otherwise, you get into a situation where there is a melt up, and then it all ends very badly. So that's, I think, my comment on the foreign flow situation.
That's a very perceptive, important thing. Wall of local money, right? So keeping things bid constantly, and as you said, that's not a very healthy thing. If you have a large portfolio, then you're happy. But if you're looking to buy, then you got to pay top dollar. Ridham, let's talk about earnings growth expectations. I was looking at earnings growth for the BSE 200 group of companies. This is the top 200, which I think institutions also track. Over the last 20 years, the BSE 200 has returned 16% returns, annual returns in rupee terms, and 13% in dollar terms. If you look at the MSCI emerging market basket, the earnings have grown 7%. That's dollar terms, so 13%, almost. So basically, the growth here has been almost double what we've seen for the MSCI EM basket. What kind of growth should we expect with them, according to you, over the next many years? Will it be high single-digit growth? Will it actually pick up from here in a significant way?
So I think index returns will be a bit more modest. 16% has to be seen in the context of what inflation India had in that period and what interest rates India had. I think the next 10 years, both of them will be lower, and therefore stock market returns will also likely be lower than the compounding we've seen over the last 20, 30 or even 40 years, because that number of 16% goes back even 30 years or 35 years. In fact, if I'm not mistaken, the Sensex data that I have goes back to 1980, and we'll probably have a similar number for a 40-year period, which is that the Sensex is compounded at around 16% or so. So I would imagine that this number will moderate into the next 10, 15 years. It will be more like 10, 11 or 12%. And that will be in sync with the lower inflation rate India should experience or lower interest rates. The equity risk premium, which is the gap between the equity return and the risk-free rate, that I think will be more or less the same. But the nominal returns, I think, will be lower than what we have seen over the past 20 or 30 years.
Okay. Another piece in your report which was very interesting to me is the talk about the Indian energy boom, right? And I think this is 1 year where this entire space is expected to come out on its own, because the last few years, although there was a lot of potential, there are still some lingering concerns for adoption of renewable energy, whether it's supply side bottlenecks, the grid infrastructure, pricing issues, etc. But from your perspective, what does this piece look like over the next couple of years? And which are the companies or which are the spaces that could be big beneficiaries of this?
So India has got a huge amount of commitment to renewable energy. We have a COP26 target to achieve. And therefore, our view is that over the next 10 years, renewables will dominate the total energy capacity addition. Our estimate is that 2/3 of the incremental energy requirements in India will come from renewable sources. And India's own energy requirement is going to grow leaps and bounds. So one of the numbers that I have cited in the recent past is that the per capita daily consumption of energy in this country is about 800 watts, which is meaningfully less than the light in your room right now. That's the per capita daily consumption. For comparison, in the US, that number stands at 9,000 watts. It's 12 times more. India will probably go to 1,300 or 1,400 watts in the next 10 years, which is a huge jump. I don't think there are too many countries that will experience a 60% increase in per capita daily energy consumption. So India will need more energy, and it will invest in more energy, and you're already seeing that. So companies that supply equipment that enable generation and transmission of this energy to the end consumer are obviously going to see very strong order books. And you can already see that in the commentary of such companies. They're already talking about it. So I think that's going to be a very exciting place. Whether stock market investors make money or not is a totally different ball game, because you have to check what's in the price and how much of that order book actually translates into earnings growth. So there are two things to check. And that may vary from company to company or sector to sector. But I think it's a very interesting and exciting space in the coming 10 years.
Okay. One final question, Ridham, before we let you go. You have your conference that kicks off today. How are you feeling about it, and how is the environment in general? Is there a big pickup in terms of both, activity as well as investments within India? Because we were just speaking to a guest a while back, a global guest, who said that now the narrative is people have gone a bit underweight on global equities, and India is looking like a great piece, which of course is your view as well. But what about the conference? How is it looking so far?
See, Sonia, I think that's an interesting question you ask, and I would actually step aside from just this conference. My interactions with global boards and global investors has been the highest in the last 6 months and cumulatively more than what I did in the last 10 years. So the level of interest in India is unprecedented, and it's bound to get converted into flows, both FDI and FPI. So I would be hyper bullish on how much demand there will be for Indian assets over the next 3, 4, 5 years. There are a few risk factors we should not forget. I mean, India still has to deal with a general election that's coming up next year, and we have to hope that India votes in a majority government. We have a potential, it's not our base case forecast, but a potential global growth slowdown and a recession, which we'll have to negotiate. But, keeping those things aside, I think the long-term story of India is certainly attracting eyeballs. And there's a huge amount of interest in India, which I've never seen before.
Okay, we'll end on that optimistic note, Ridham. There's a huge amount of interest in India, which we've never seen before. Hopefully, it'll bode well for the equity markets as well as, in general for the macro economy. Thanks a lot. Great pleasure speaking with you.